Okay. Uh, Hello, welcome to all. I am myself, CA Vijay Chauhan. I am moderator of this webinar. We are delighted to welcome you all in the webinar being organized by the Continuing Professional Education Committee of ICI. It is my pleasure to be moderator for the webinar on emerging capital market trends and burning issues related to of MSc Excel on under section 43BH. In a short while, we will start this webinar. First, I would like to apprise you about CPE committee. The profession of chartered accountancy is growing leaps and bounds. It is phenomenal growth. Its phenomenal growth has brought the profession at the forefront. Today, our profession has acquired an indispensable position in the business and economy. ICI is continuously aim at developing knowledge edge so that the members stand out to the expectation of the society. To achieve this objective, the CPT committee of ICI has been continuously striving for the perfection, integrity, and knowledge which make the word chartered accountant synonyms with the excellence in the service. In this direction, CPE committee has always been proactive to the emerging need of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CPE program and providing adequate opportunities. The program for this evening is as follows. We have two sessions of 1 hour each and topics are first, emerging capital market trend and wealth creation, which will be held by C. Ajay Sanjay Shah sir. And second, burning issue on expenses to MSC under section 43BH, which will be held by C. Chintan and Patel sir. Our eminent speaker will talk about the above mentioned two emerging areas of professional interest. Okay. Sir, firstly, I would like to welcome CA Alay Sanjay Shah, sir, our faculty for the first session. He is a qualified chartered accountant, also holds honors in BSc from Oxford Brookes University, London. He has a vast experience in the audit, tax, and regulatory compliance of capital market, corporate, etc. He also has 6 years of experience on capital markets and believes that the wealth can be created with the right selection, process, and performance. Okay, sir. Over to you, sir.
Yes. Thank you for such a nice introduction, Vijayji. Firstly, I would thank for this immense opportunity. I would thank the CPE committee and organizing such a session just before the budget day. So I would like to, and the topic is also well selected, emerging capital market trends and wealth creation. I would also like to thank CA Purushottam Khandelwal ji and CA Gyan Chandra Mishra ji for giving me this opportunity. So now we can start the session. Correct. So the session we have selected is emerging capital market trends and wealth creation. So today we are going to talk about the emerging capital market trends, which is going on in the sector themes. We are also going to talk about some macro data, whole economy as a whole. We are also going to talk about new trends which is coming up in the investment products and the wealth creation side. And lastly, we are going to take up how one can create wealth through diversified portfolio and good asset allocation. So let us start with some macro data. So as we can see, India is on a growing trend. Right now, the government is taking up initiatives to open up FDI in India. They also open up a lot of sectors such as defense, banking, finance, technology, also up to 74 or 100% they have allowed. So as we can see in the trend, from 2000 to 2023, the FDI has gone up to more than 35 times. It is also due to a variety of factors, such as, for example, let's see, 2023, Foxconn had been introduced. They had committed 600 million to production facilities in India. Foxconn is for the Apple manufacturing. This will also lead to a lot of synergies, increase in GDP and increase in economy as a whole. But there is also an inequality when this FDI has been given in India, such as only 3 major states have been a part of this FDI inflow, such as Maharashtra, Karnataka, and Gujarat. They have also become the destination of 70% of the $70.9 billion FDI, which between the last 22 and 23 FI. Also, sectors such as banking, finance, and tech account for one-third of the FDI. Despite of the government's flagship Make in India manufacturing program, they're also trying for the automobile manufacturing, which is still yet to pick up the pace. This can also be a good sector and an emerging trend such as the automobile manufacturing and automobile ancillary services in India. All this FDI inflow has been a part of the initiative of the government's FDI laws in 2021. They also did away with telecom, oil, and defense industries in the last year. As we can see, the government's top five sources of FDI have been Mauritius, Singapore, and the United States. Government of Singapore believes heavily in the India's growth story. It believes that India is truly to become a Sone ki chide in the next few decades, and even the generational wealth can also come. So there is a lot of paradigm shift in terms of the whole world economy, global economy that is happening. Right now, China is poised to become a number one economy by 2036. But India is also following its footsteps by becoming the third largest economy by 2036. Right now, at present, India is at the sixth number of place, which is expected to become number third by 2036. The lot of demographics are also playing in favor of India, such as a lot of young population, working population currently is present in India. The country's economy had a lot of room to improve than other nations. While the median age in many mature economies is shooting up, India has a youthful resource. In fact, as you can see in this picture also, India has a youthful workforce. India's median age is in fact full 20 years lower than Japan, which is currently the third largest economy in the world. So the macro data is favoring in India. Demographics are also favoring in India, but population can be a concern for India, such as poverty has to be managed, disease control also has to be managed, and good incentives and uh, population has to be given so that the poor economy or the lower below class can also come up. Now let us start with the sectoral or the capital market theme. A lot of almost everyone joining in this webinar must have invested in some IPO or the another in the last year. In 2023, there were more IPOs in India than in the US. This fact states that India is a growing economy. A lot of companies are coming into the public market. They're trying to generate or acquire wealth and fund their resources by taking it in the capital markets. But at the other side of the table also, by this optimistic sentiment and a robust short-term outlook, corporates, promoters, and private equity players are trying to make the opportunity or the short-term money. They are speculating by making the companies public. Also, a lot of private equity players are pushing companies to go public because of this huge fund inflow that is coming in the main board segment and the SMA segment. A lot of opportunities also exist in the QIB, FPI, and Ultra HNI segments, such as almost 50%, not less than 50% of the IPO is allocated to QIB. QIBs can be mutual funds, pension funds, insurance, etc., and they can almost invest a lot of money and make a good speculative short-term profit out of it. Nonetheless, IPO is a good opportunity to invest. Right now, the sentiments is also very nice with the Ram Ayodhya Mandir, etc. going on, and a lot of Gen Z, millennial investors, young investors coming into the market. A lot of fund is coming into the market as well. As we can see in the last year, there were more than 100 IPOs which were issued with issue price of more than 500 crores, out of which 23% gave more than 60% returns, which in comparison to year 2022, 0% IPOs gave more than 60% returns. On the downside, only 17% of this 100 IPOs gave negative returns. 34% gave 0 to 20 returns, 12% gave 20 to 40% returns, 14% of the IPOs gave 40 to 60% returns. And many lucky attendees of this seminar would also have been a part of IRDA, Tata Technologies, Utkarsh Bank, New Netweb Technologies, Gandhar Oil Refinery. If you have been allocated this IPO, you must be very happy with the results and the listing gain. Now, this we talked about the main board segment. There's also this IPO segment of SME, which is a small and medium enterprises. So the issue price of this segment is usually very less. For example, recently, last day only, Nuva Agritech company got listed with an issue price of only 33 CR. But it received a bid of around 10,000 to 11,000 crores, which is 300 times of its issue price. You can see in the trend from 2021 to 2023, almost 8 times more fresh capital has been infused in this SME segment. Now, as an economy, as a macro economy, this fact and this figure is very important that even SME enterprises can take up money from the market and fund their resources and ambitions. They do not need to go to the bank or any other financial institutions or take up any other market gains for funding the resources. So SME segment is also a very lucrative opportunities for those trying to gain out of IPOs. Now the second and very complicated, I would say, market trend is arbitrage. Now a lot of people have been fascinated with this idea of arbitrage. Now arbitrage is usually exploiting a difference between two same assets, or let's say an asset listed in different exchanges. Or another way of doing it can also be exploiting the difference between the spot market price and the future market price of the same. Now, this strategy is very complex to implement. A lot of people have also gone bankrupt into this, and a lot of people have become billionaires out of also this. It's a very fascinated notion of investing in arbitrage. But as we can see, arbitrage funds become the most purchased category, seeing gross sales over 1.59 lakh crore. The mutual fund usually benefits from the cash futures spread. That is, they buy in the spot market and they sell in the futures market. Let's say the futures market is spread over a 1 month period and they usually profit out of the same. A majority or 65% of the portfolio of arbitrage funds is invested in this. Balance is invested in debt or money market instruments to provide liquidity for the same. Now, two very important aspects that are required for arbitrage is the asset price mismatch and the simultaneous transaction. Asset price mismatch is the same asset should trade at a different price in different markets for arbitrage to happen. And simultaneous transaction. Sometimes arbitrage, this hedge funds, venture capital, equity players, they also carry out transactions in a very microsecond or a millisecond. They have this huge algo trading software and very complicated strategies going on. So the gap or the timing has to be very important in this. If you are an individual trader and you are carrying out arbitrage, you should carry out buying and selling of assets in different markets simultaneously. The window of arbitrage is open for a very small duration. So earlier one carries out a transaction, the higher of chances of generating profits. As we can see in this figure, I've introduced a comparison between the liquid funds and the arbitrage funds. Now, though we can see that arbitrage is termed as a riskless or a risk-free trading or a risk-free return on the capital, but in comparison to the liquid funds which invest in T-bills, government bonds, G-Secs, arbitrage has not come up to that level. It is still providing very meager returns as compared to the equity or another market instruments. Even in comparison to the liquid funds, you can see as on March 2023, liquid funds provided a return of 5.41%, whereas arbitrage only provided a return of 5%. But nevertheless, it is a very good way in terms of market downturn, in terms of economic downturn, in terms of geopolitical tensions, terror tensions. Arbitrage can play a very huge role, and it is termed as a risk-free trading software. There I also listed two arbitrage. One, he can invest in funds such as Kotak Equity Arbitrage Fund, Nippon India Arbitrage Fund, which is very accessible, and one can invest in small amounts as well. Private equity. Again, a huge coming up market trend in the economy. Private equity firms, everyone knows what it is. They basically take money from investors and they usually invest in companies which are not public yet. And they take over the operations, they manage the strategies, they increase the efficiencies, they increase the performance, and plan to take an exit after a significant amount of time. Usually taken returns of more than 10x times or even up to 100 times in some cases. But when it comes to choosing a private equity firm, businesses should consider following points, such as portfolio and investment strategy. What is the firm's portfolio and investment past investment performance, so that the investor can get a better idea of how to invest and to whom to give the money. Also, expertise and track record is very important for investing in a private equity AIF. Industry network and connections of the firm are also very important, and its exit strategy. Sometimes what happens is this PE take money from the investors, they invest in all these private companies, but the exit strategy is not clear. Also, the exit strategy can be very harsh for the company. Usually, the exit strategy for private equity players would be mainly IPO and another takeout by another PE player. So exit strategy has to be very clear when investing in such an AIF. So following other data of what PE players are, this I have included very famous names such as Blackstone, KKR, Warburg Pincus, Bain Capital, Carlyle Group. They have invested in companies such as Nexus Malls, Emphasis, Bharti Infratel, Bharti Airtel, Axis Bank, Emcure Pharma, which is yet to be listed now. This year, they are planning to take out the IPO, in which Bain Capital, of course, make a very handsome profit and make a multi-bagger return out of it. Also, Carlyle has been invested in PNB Housing Finance, Delivery, Logistics. Of course, this year also it got listed. Carlyle made a handsome profit out of it. Now, the important point to be considered is the future of private equity in India looks very bright with a multitude of investment opportunities across various sectors. Whether you are a business seeker, investor, or just for an opportunity point of sake, it is worth keeping an eye and keeping on this trend on these leading private equity firms in India, such as Carlyle is managing assets of $246 billion. Blackstone is managing $500 billion in assets. Moving on. Of course, we all know this is India's era. The whole world knows it. You have seen the FII inflows in the past 3 years. All governments, pension funds, insurance companies, all big mutual funds are coming to India, having a better growth story, having a better return expectation. They're investing in India in huge amounts of money. It is expected that India's average real GDP growth is 7.2% for the year 2021 to 2026. Across almost 70 unicorns were registered at the end of 2021. The data for end of 2023 is yet to be released. Bain and Company reports that the total value of private equity deals was $70 billion in 2022, a significant increase from $26 billion in 2019. Now, this private equity players take very deep research. They study the balance sheet, they study all the companies' ins and outs. They know how the company is going to perform, how the industry is going to perform. They also study the government monetary fiscal policy and have a deep, thorough analysis. So instead of as an individual investor, if you do not want to invest or take up all that hard work upon yourself by investing in a non-listed company, you can give money to a private equity AIF, which is going to do the same for you. India is, of course, a consumption-based economy with population close to around 1.44 billion right now, which is at par right now with China. Of course, the consumption is going to increase. People are going to spend on discretionary products. They are, of course, going to indulge in luxury products. As we can see, per capita GDP is expected to double from less than $2,500 in 2022 to nearly 4,000, which is doubling to 2028. So discretionary spending is expected to go up for a very long time. FMCG is going to profit from that. A good sector trend is also FMCG, which is going to go on. government is likely to enact new initiatives that would support less affluent parts of the population so that the consumption also comes from that part of the population. Right now, a ruralization is accounting to more than 40% of the total population. Government is trying to promote initiatives and promote such segments to come up to the urban areas and spend on products and such. So all companies, FMCG, discretionary products, electronics, industrials is of course going to increase. Urban consumption mainly has been increased in financial services, which is the factor or the driving factor for the Indian growth story. The data has been amazing, which has come from end luxury product sales. Passenger vehicles are increased or released vehicles are coming in very good number. Domestic air traffic is coming. Interglobe aviation is profiting from the same, along with growth in personal loans. As you can see, more than 90 million cards is being used in India, with some people more than earning just $10,000, which was less than even 50 million credit cards in 2019. So all UPI, credit, SBI cards and payment services, all digitalization is coming into effect, and the government has been very positive for the same, and it is going to keep on an uptrend, so on and so forth. So, on a macro level data, India's industrial output has risen 9.2 percentage month on month in November. It was the highest, which was 11.6% in October, but due to some downshifts with the economy and some factoral growth changes, it has come down in November. But as we can see, food products are on a rising scale. Chemical and chemical products are on a rising scale. Pharma is increasing. Metals is on a very good scale. Machinery and equipment, which is industrial equipment, is also on a very good track. I've also included some high frequency indicators. The index of industrial production grew at a robust 7.3% during the quarter, along with 13.9% growth in electricity. It was, of course, our honorable PM's dream to give electricity or bring electricity to each and every house, each and every house in India. The PMI manufacturing is around 57.93 percentage over here. Steel has been increasing on a very good trend, on a very stable, sustainable growth. Quarter on quarter, it has been increasing to come to 19.23 percentage in quarter two of FY24. Cement has also been increasing. It has increased to 10.3 percentage quarter on quarter in quarter two FY24. As we can see, domestic passenger vehicle sales is also increasing 21.53. A lot of people are now buying cars. So the demand for automobiles, automobile ancillaries will always going to increase. Passenger domestic aviation is also increasing on a very sustainable growth after COVID of 23.1. Moving on. So now India has outpaced China in GDP growth. Earlier, before 5 years, China was the FII's hub for investments. It was every mutual fund's comfort zone. They would always go to China for investing. India was always been neglected as an emerging market. It was always looked upon after China. But right now, India has outpaced China in the GDP growth with 7.2%. The growth in GDP in China has been stagnant with 2 to 3 percentage right now. In 2023, India became the world's most populous country, and in 2024, the increase in population growth will register in economic terms. Manufacturing will also shift away from China. Right now, all industrials, all sectoral segments is done by China. All outsourcing necessities, all outsourcing needs is being completed by China. But moving forward, India will also take up that position. But however, transition is two-sided. India is investing in infrastructure and courting foreign investment, while China is investing in aircraft carriers and turning its gaze inwards to deal with youth employment and sectors crashing. While looking at other nations, many experts are predicting we'll see India outpace China when it comes to real GDP growth this year, especially if the trend of manufacturing foreign investment shifting away from China continues. So the big question and the elephant in the room is India the next China? Of course, in terms of population, we are at par with China or even more than China right now, but not in terms of GDP. We are only a size of the GDP of China. Right now, India is growing at a very high rate since China over the last decades. India could come up as a world player. It could be a one-stop solution for all industrial needs, and it can come up even better than China in a few years. So, as per this graph, we can see that if India is poised for a growth of more than 10%, it can become the next China in terms of GDP for the in next 21 years. Whereas if we consider a low stagnant GDP of 5%, it will take around still 57 years to come up to the GDP level of China. However, as per China's growth ebbs, investors look for alternative markets. India has become a generational opportunity to become the growth engine of international markets and emerging markets, as GDP is expected to grow around 6% for the years to come. India is, of course, blessed with youth populations, which provides a demographic dividend or a demographic advantage. The demographics is favoring us. It is also very market friendly and democratically elected government. It creates a very beautiful backdrop for stock selection and potential performance in the global economy for the years to come. So this is the population analysis. As of now, 2023, we are at par with China. But as we can see from the graph, in 2100, we would outpace China by over 800 million population. So we can see that the population will also translate into economic terms. It will also translate into GDP terms and real economic growth. There is a decline of foreign direct investment in China because of the obvious reason, the obvious neighbor. India is always a better place to invest right now with markets booming for the next around decade or so. And the past 3 years, we have seen a lot of FII flows in India. China FIs are right now taking money from China and putting in India with a better growth story and a better promise for returns. So this is the cost of living in the world. This we can see as a market trend. Right now, New York is considered to be the world's most expensive place to live in. So on the y-axis, we have included the cost of living index. On the x-axis, we have included the local purchasing power index. So for example, let us take the example of top left city, which is Beirut, Lebanon, and purchasing power index is just 15. So people are having to spend more than they are earning basically, which is counterproductive, counterintuitive for the economy as a whole. And the standard of living also goes down in those countries. Whereas if you come to bottom right, we can see Bangalore has a very good aspect of purchasing power parity to cost of living index, whereas people are were having bigger and more purchasing power than the cost of living. So the savings can increase, the investments can increase, and all this money will sooner or later translate into all these asset classes. Now let us talk about the emerging sector themes which is playing out or is soon going to play out in the market, which is renewable energy. Of course, we saw IRDA coming up with an IPO with a bumper listing gain of 92% in recently. India is the third largest consuming economy in the world. Sooner or later, all the fossil fuel, oil and gas is going to perish. It is not going to last forever. All countries' economies is soon turning up their sustainability programs to include solar, hydrogen based fuels to replace the fossil fuel based. India currently stands fourth globally in renewable energy installed capacity, fourth in wind power, and fourth in solar capacity. Now, this theme is basically very much underplayed in the market. Not a lot of companies are listed in the markets as well. A lot, and the companies which are listed in the markets are having a very less contribution of the total turnover which is expected by the government. Green hydrogen production, which is characterized by zero carbon emissions, is also considered a very good investment resource right now. The companies which are targeting green hydrogen, for example, if you are updated with the news, recently Larsen and Turbo announced that they are commissioning a project in green hydrogen production. So these themes will sooner or later by 2030 come into play, and hydrogen is anticipated to play a significant role in sectors such as steel, mobility, and fuel blending. So these are the 15 largest solar plants in India, in the whole world. The biggest solar plant is in Badla, which is 2,245 megawatts capacity. Even the third largest solar plant in the world is in Pavagadh, which is of 2,050 megawatt capacity. So India is already trying to install all the solar plants and expect turnover to arise in the next coming years. Now, the second theme, which is going to play out in the couple of years, is travel, or it has already coming to started to play out. Now, the world's most populous country is, of course, going to spend on travel, and it is going to be the fourth highest globally by 2030. But right now, we can see the share of India in international tourism receipts is only 1.64%, which is very less. On the other side of the table, we are spending a lot on travel and hotels in other countries and etc. But for example, government is trying to come up with the initiatives to put more emphasis. For example, PM Modi started the Lakshadweep concept of, instead of Maldives concept. So government is envisioning $56 billion forex, and it will create 140 million jobs in tourism by 2030. So tourism and hospitality travel is of course going to play out in the next coming years. Indigo has ordered the world's biggest fleet of airplanes, 500 in the world, which is the biggest, even more than Qatar, Emirates, Saudi Arabia, Riyadh Air. Air India has also passed a fleet of 470 planes. India is the world's third biggest domestic aviation market, and by 2042, its market is projected to be 5 times larger than 2019. So this is the data which is for the domestic airlines. The total number of passengers carried by domestic airlines rose by 10.8% year on year in October to 126.4 lakh. As we can see, Indigo is having the highest number of market share, which is 62.6%. Interglobe Aviation is sooner or later going to translate all these profits. Right now, it is not reporting its net income to the level it should because of several components such as interest, depreciation, and tax treaties. But sooner or later, it is going to play out very well. Now, metals is a very favorite sector of FIIs. We have seen the rally, a huge rally in metals in the last 2 years. It has witnessed tremendous growth, and India has emerged as a global force in steel production, and it is the second largest producer of steel in the world. Partly, it has to do also with the government reforms and the activities they have carried on, such as putting on restriction of import of stainless steel from China. This is due to the Make in India segment also. It is expected that the rally will also continue for the next decade or so, with metals and mining in India expected to witness a major reform in the India. As we can see from the graph, the per capita steel consumption has been increasing on a 43% basis. It was just 60 kg in 2014-2015, and it is 86.7 kg in FY22, FY23. Defense defense is a sector which is going to go evergreen. It is never going to stop due to the geopolitical tensions. We have seen in the past couple of years, Russia Ukraine war, even in Iraq, Middle East, defense is never going to. It is said that right now the inventory of defense or all this militarily, air force and fleets is so rare. Anywhere in the world, in any corner of the world, the inventory is sold within 1 hour. So all these companies are expressing huge demand, supply of which they cannot fulfill. And sooner or later, government has also included or restricted. Earlier, they used to add restrictions in FDI in the defense sector, but now they have opened up to 74% through the automatic route and 100% by the government route. But however, we can see that the share of GDP spent on defense is just 3.3%, but it is increasing on a 13% basic budget over 23-24 over the 22-23 budget. Ministry of Defense has set a target of achieving a turnover of $26 billion rupees, $26 billion in aerospace and defense manufacturing by 2025, which includes $5 billion exports. Till now, till April 2023, a total of 606 industrial licenses have been issued to 369 companies operating in defense sector. So in the coming years, we could expect a lot of new companies coming into the market, coming with new ideas, with new proposition, with new robotics and artificial intelligence, revolutionizing the defense sector. So this is a theme which is to be kept in mind, and careful analysis has to be done to select companies for the same. So digital tech and AI. So this is a sector theme on its own, and it is an industry on its own as well. Now, just to give you a very brief data, according to International Development Corporation, digital technology is expected to grow at 2x the economy in 2024. Almost 60% of Indian enterprises revenue is expected to come from digital business models in the next 3 years. We can see that even in the US, even in India, tech has always been the favorite sector of everyone. But what happens is these companies usually run up their valuations. They are not available at a favorable valuation. So digital disruption has become essential for enhancing customer satisfaction, boosting revenue, and fostering innovation. Now, with all the disruptive technologies that is coming into the place, this is a very unique study. It will also require the demand for very disruptive materials such as zinc, copper, and other metals. For example, the lithium battery shortage or the semiconductor shortage that happened in the last few years, it is always going to continue with the new increase in cars and semiconductor chips and in digital technologies. For example, copper market is expected to shoot up to $394 billion by 2029. And as we can see, cobalt, which is currently not a such developed market right now, even no one has heard of it, but it is expected to shoot up to $17.3 billion by 2029. And it is expected it will grow at a CAGR of 12.5%. So companies which are usually investing a lot of into this materials and this commodities, we need to keep a track on that. It is going to come up as an emerging market trend, and its market is going to shoot up. Blockchain. Now, everyone has heard of crypto and NFT, but unfortunately, crypto has been a bust. NFT has been in a bubble. It was expected that it was a fad, and 2-3 years the bubble actually burst. But I think it has a more to prove right now. The concept, the blockchain concept, is more revolutionary, more advanced, which didn't do justice by the cryptocurrency and the NFT technology. Now, blockchain technology is set to disrupt the traditional financial systems. The concept is very unique as creating a unique ledger with better transferability, better accessibility, and better clarity. Right now, for example, as started accountants, we can see that CAs are constantly submitting the tax returns to the government and etc. But just imagine in a world where traditional financial systems are not existing, only blockchain technology is there, where each and every trail of transaction, each and every rupee is been credited to some ledger and debited to some ledger. It is transparent to all, it is visible to all. Government will not need to be provide to AIS and TIS. It will know on its own that which money has moved on its own. Also, money laundering can be gone, terror funding can also be eliminated. Also, it is expected to revolutionize the capital markets industry while the global virtual stock broking. Global virtual stockbroker and digital investment market is expected to grow from $3.5 billion to $11.2 billion by 2028, which is growing on a 27.8% CAGR during the period. So this is the expected themes which is going to play out as per a study, as per a global study. Number one, accounting for 58% growth is robotics and artificial intelligence, which is going to play out in the next few years. Next to it is blockchain. Cannabis is also expected to go out very well. Solar, data centers and digital infrastructure, cyber security, wind energy, e-commerce, metaverse. All this is going to play out in the next very few years. Now, MSME and urbanization. MSME is the building block of the economy. It has been in the shadow for some time now, but government has played its emphasis and it is promoting MSMEs to come out. Usually, right now, also SME platforms is also on a burst right now. Usually, all the notion that only big companies or large corporates can take up money from the market is vanished now. Even small companies can come up in that segment. But as a supportive industry, the three major supportive industry that MSMEs and urban rural players play in is textiles, handicraft, and ceramics. So with the moving onset and reforms coming in the MSME sectors, these three themes can play out very well. It is expected that by the end of FY 2023, India is estimated to have 75 million MSMEs. The sector has been responsible for accounting 30% of the country's GDP, 43.6% of merchandise exports, and close to 123 million jobs to employment. But on the downside, also, the sector has been very vulnerable to fluctuating commodity prices, global trade, and dumping from China, and changing regulations and standards among them. But demand for loans in that sector has gone from 33% in the first quarter, while non-performing assets at the NPA ratio is also declining very well. So MSMEs is, of course, one of the favorite components of the economy or the structure which is going left. MSMEs are, of course, huge growth potential. They are likely to produce 10 to 15 million jobs in the next decade. Government is going all in helping MSME to rise to their full potential. It's a good sector trend, and also companies which are dealing day in, day out with MSMEs can also benefit from the same. Now we talked about emerging capital trends, emerging capital investment trends. Now let us talk about the emerging capital market countries. So MSME has introduced an index which constitutes of 24 countries which are emerging markets, such as India and China, of course, are emerging markets. They have the biggest share of the emerging markets, but there are countries such as Brazil, Indonesia, Chile, South Africa, which are also going up and increasing a lot. They are also developing economies. They are increasing jobs, reducing poverty. It is said that EM country markets have represented over 75% of global land, almost 90% of population, and 60% of GDP. But they only considered up to 11.7% of global market cap. So there is a huge underperformance or an underweight that is playing out in the emerging capital market countries, which can be explored later also. Now, from the graph that we can see is in December 2008, emerging capital markets were completely neglected. More emphasis or more money was flowed to the developed countries or developed markets. But right now, the trend is changing. As we can see in December 2022, 40%, more than 40% overweight has been given to developed countries or developed markets rather than what used to be in 2008. So investing in India is of course one option, but there is also an option that a part of the portfolio can be invested to international market equities such as Brazil, Chile, South Africa, which can pan out very well for the next few years. As we can see, the emerging markets weight in global equity funds is only 4.4%, but as per the frontier markets index, it should be 11.7% as per the global market cap. So right now there is a 7.3% underweight. There are a lot of mutual funds, there are a lot of private equity players, a lot of hedge funds that help small investors of accessible amount of money to invest in these emerging markets with very ease and very tax friendly compliances. So this is a top global risk on a macro point of view, which is going to pan out, or as per survey, going to pan out in 2024. The biggest risk is extreme weather. Second is AI generated misinformation. Third is political tension, cost of living crisis, cyber attacks, economic downturn. Interestingly, the least risky component is tech bubble blast or the housing bubble blast. So this is the geopolitical risk of all selected countries. We are blessed to be in a very democratically friendly government with a risk index of only 58. Next to it is Brazil with 162, US 174. Of course, the communist countries have a bigger geopolitical tension. There are frequent policy changes, frequent politics going on. So China and Russia are at the highest scale. Right now, the FI has been selling for the last 4 months, but it is usually because of a increase in the US bond yield, with the 10-year yield surging from the recent level of 3.9 to 4.15%, triggering capital outflows. But they are also investing in emerging capital markets such as Taiwan and Chile and South Africa. But apart from even FIs selling in India, India markets has been growing on an uptrend only. So it used to not be the case for the past 3 years. If FIs used to flow money into the market, markets would go up. But mutual funds and domestic investors did not have much say. But right now we are proud that we have reversed that trend, and even FIs are selling, we are increasing the market. Now, let us come to the second part of the discussion, which is wealth creation. Now, wealth can be created in a lot of ways. India, of course, is home to some biggest billionaires in the world, such as Ambani's and Adani's and etc. But we can see from the graph, US is home to 22.7 million millionaires in its country, whereas India is only 8,50,000 millionaires. Even Hong Kong, with a population of 60 lakh, has more or comparable millionaires than India. So, in the next few decades or in the next 20, 30 years, I hope the attendees joining this seminar will be a part of the millionaire segment. So, there's a lot of scope which is going on. Now, usually wealth or asset is usually created in for all this broadly can be categorized in this 5 segments, which is equity, fixed income, which includes bonds, debentures, etc., commodity, which includes gold, bullion, and etc., real estate, and others. So, asset wealth can only be created or assets can be allocated in this 5 broad segments. Let us take up each one of it. So I've categorized a graph which shows the risk and reward properties of the main asset classes. As we can see, equities offers the highest risk and the highest reward ratio. Next to, if we take up on an extreme end, it is cash. In cash, there is no risk, only the risk of losing out on inflation, but there is no reward as well. Government bonds is pretty moderate in terms to that it is a fixed income, fixed reward, and a fixed risk. The risk of default is not much in some very categorized bonds and etc. But only in bonds there is a risk of default that comes into the picture. Property, as in real estate, offers a good risk to reward ratio, but in comparison to equity, it will of course come less. Commodities at the same end of time offers more risk but offers less reward. So this is the asset classes. Now talking about the performance of the Indian equity markets, Sensex returns among the highest in the world, only next to Nikkei, which is the Taiwan index. Nikkei gave a return of 31% year to date as of 27 December. Sensex returned 17.8%. And as we can see in China, it gave a return of negative 17.5%. This is a list of all the top 50 companies which are currently valued in India. Highest is Reliance. Next to it's HDFC Bank, SBI, Bajaj Finance, TCS, Infosys, etc. are also a part of the same. Now, a very thoughtful comparison is that what would be the case if you had 1 lakh rupees which you had invested 20 years ago in simultaneously equity, gold, real estate, and debt. So, for example, as you can see, the India has given a 17.2% compounded annual growth rate in 20 years. Gold has given a rate of 12%, real estate has accumulated 9%, and debt has only given a return of 7.2% over the 20 years. So, for example, let's talk about absolute terms. If you had invested rupees 1 lakh in Indian equities 20 years back, it could have grown to approximately 24 lakh by now. But if you had take the same amount and invested in gold, it would have been 9.6 lakh. And in real estate, it would have been 5.6 lakh. And the value of 1 lakh rupees invested in the US equities could have been just around 11.3 lakhs in 20 years. So this shows the power of compounding, the power of equity in the markets. So of course, equity versus fixed income. FD of course gives a very simultaneous standard rate of 6 to 7% dependent upon the repo rate and RBI policies. Equity has its ups and downs, but over the years, as we can see, equity has been given phenomenal returns over the past years. But right now, over the world, if we talk all over the world, rupee denominated government bonds produce a 7% total return, beating all world benchmarks with returns just between 3.5 and 5.9%. So let's say if you are a grown investor, you are a matured investor with some income and paying outs, you do not want to take much risk. So rupee denominated government bonds also have a very modest return, which is best in the world right now. So as we can see from the graph, Indian stocks have started to outperform those of China and emerging markets on an overall basis. India has, of course, moved out of its comfort zone and territory and is producing return more than emerging markets and as that of China as well. Now, if we talk about the bond side, India bonds has also been outperforming its peers. It has become less volatile than the emerging market peers since 2023. As we can see from the graph, the bond market volatility is only 1.45 percentage, while emerging bond market volatility is almost 6 percentage. So investors are also very comfortable if they want to invest in bonds. The volatility is very less as compared to the emerging markets. Now, this also signals a very good factor for the developing economy, that access to funds is always easier. Investors are comfortable and feel safe when they invest into bonds and fixed income securities. Now, this is the comparison between various asset classes. Let's talk about equity. The return potential is, of course, above inflation. Volatility in returns is very high. Liquidity is also very high. If you can sell today, you will always receive the money in 1 or 2 days. One can always invest in small amounts, and complexity or the analysis or the understanding part of it is average. But of course, one should hire an investment advisor or route their money through mutual funds, etc., while making investments. On the other hand of it, we can see in fixed income is near inflation, volatility is low, liquidity is very high. One can always invest in small amounts. Yes, there is no complexity related to it, so it can be a good option of earning near to inflation. Whereas in the real estate, return potential is almost next to equity, but volatility of returns is very high. Liquidity is extremely low. Of course, when you sell, you also have to incur a stamp duty of tax of 6 to 7% on both sides of the transaction. So it may not always be possible to trade in real estate. You cannot invest in small amounts in real estate. The complexity is high as compared to the equity markets. The same goes with commodities. Complexity is high, volatility in returns is high, liquidity is low, and one can maybe or maybe not invest depending upon the lot size and in view which segments they are trading. So let's come to the right hand side of the table. We can see how individual wealth has been allocated in India. So direct equity is a portion of 21.4% of the total wealth. FD comes to next, which is 20.7 percentage. Next to it is insurance, saving deposits, cash, provident funds. Now, an interesting part is mutual fund is only 3.4 percentage of the total individual wealth invested in India. This figure is, as you can see, the year-on-year change is 40.5 percentage increase in mutual fund. I believe this figure will at least go to next to direct equity in the coming 10 to 15 years. Also, international assets are a proportion of just 0.1%. We can invest in emerging and markets and international equities to have a better return and better diversification of the portfolio. Now, apart from all these asset classes, we can also have another way of creating wealth or acquiring wealth, such as succession planning. For example, division of wealth between family members can also give you wealth. Ring fencing of assets, estate duty planning, as in saving on stamp duty tax and other taxes while selling or buying real estate, can also help in creating wealth or accumulating wealth. There is also stake sale, acquisitions, and divestments which can help in acquiring wealth. Now, a very interesting part is citizenship or residency planning. Obtaining citizenship or residency of a country by making investment in it. Now, there are a lot of tax havens which are always Hawaiian Islands, Cuba Islands. Ireland is also very popular among them. Portugal, Greece, Malta, etc. can help reduce your tax. Also, now next to just a dream project of the government is the gift city structuring, which is helping in creating tax benefits and tax havens, which can also be a very lucrative option. Now let us come to the asset allocation models. We can basically divide asset allocation into three broad groups. If you are a very passive investor, not much risk taking appetite, you can have a 70 to 100% in bonds and with the rest in mutual funds, equity, or in AIS. A balanced portfolio, as in you are in 30, 40, 50 years of age, you can take up to 40 to 60% in stocks and the rest in fixed income like bonds, debentures, NCDs. Now, if you're an enterprising investor, you are young, you want to have a go at a career, you can have 70% to 100% in stocks. Usually, young investors should take more risk while investing. Right now, the market is booming. Right now, it is of course going to have a very uptrend. GDP is growing on a very constant rate, so more risk or more can be taken in equity. This is the typical asset allocation of a investment portfolio. 50% of the stocks, 50% of the assets can be invested in stocks. This is a very generic, typical idea of what one can do. 40%, 30% should be invested in bonds, 5 to 10% in commodity, and 5 to 10% for cash in terms of economic downturn, terror, geopolitical tensions in case it comes. Commodity will include gold, bullion, etc. Now, within the stocks category, there is diversification can be done as per 50% can be done in large cap, 20% can be done in mid cap, 10% can be done in small cap, 10% can be done in international equities in developed countries such as US, UK, France, Germany, etc. And 10% can be invested in emerging markets such as Brazil, Chile, South Africa. The goal of strategic asset allocation is to create a portfolio based on the investment goals and risk tolerances. You should always consult your investment advisor in case of the same. Now, there's an upcoming trend of investment products such as AIF has come into the picture. A lot of AIFs are there, such as venture capital, private equity, infrastructure, social venture, funds of funds, which Motilal Oswal is doing very well right now. And it is investing in the US capital markets. There is also debt funds and hedge funds. Hedge funds use, of course, arbitrage, they use algo trading and many complex softwares for the same. So right now, these are the figures that AIF has garnered or has collected funds for the same. In June 23, as we can see, commitments of 8,44,926 crores has been done in comparison to June of 6,94,000. So AIF is also on a booming trend and it has grown more than 10 times in the past 5 years to become a 8.5 lakh crore industry. Now, let us talk about having a multi-bagger stock in our portfolio. What can be the effect of having a multi-bagger portfolio? As we can see, let us assume we take a 10 stock portfolio. Out of the 10 stock portfolio, only one has to turn out a multi-bagger or give you 10 times return in 10 years. As we can see at the 0th year, the CAGR of the portfolio is 3.1%. But at growing each year, it increases, and we can see that just one stock out of 10 that goes 10x bumps the ending portfolio value from 3.1x to 3.8x of the initial amount, and keeping in mind on the constant same of the portfolio CAGR of 2.3%. Now, this is also a study of how the market has grown. For example, as we can see, before 10 years, 15% of the companies with market cap more than 100 crores grew 10x. For example, 150 companies gave a return of more than 100 crores of profit. So we need to track all the superhero stocks and plan to take analysis and include in our portfolio. So this is the very analysis of how the companies are given returns. For example, a very popular name such as Bajaj Finance has given 100 times return in the last 10 years. Before 10 years, the price of Bajaj Finance was just 83 rupees. Right now, it is hovering in the range of 7 to 8,000. But I won't take much of the time. Of course, my time is up, but just 5 minutes more. As we can see that Bajaj Finance had very modest indicators, very modest ROC, net margin, and early sales growth. It is just that it has been very consistent in improving its fundamentals, improving its efficiency, and it has gave a return of 100 times in the past 10 years. So selecting or analyzing or selecting a 10x multi-bagger stock is not that difficult actually. We just need to spot out simple but effective trends ratios, and we just need to keep on monitoring on an year to year basis. As it has it gone constantly to improve its margins, has it gone out of the way to improve its margins and other factors. So 10x stocks had better fundamentals, but not by a massive difference. Better ROC, slightly better sales growth, and inferior profit margin, which was just slightly better than the other companies, which did not give as much returns as those portfolios. But it retained superior ROC, sales growth from the early years for the 10 years under consideration, and fundamental superiority over the rest. As you can see, the PE before 10 years of the 10x stocks was just 14.9. Right now, its PE is 50 times. So, overall, if you can see, people are also willing to pay 3 times more than they used to 10 years ago with the same increase in profit, same increase in ROC, ROA margins. Now, this can also be an optimism built into stock prices that markets today are more positive than it used to be 10 years ago. This is a price equity change. For example, for the not modest stocks or the all stocks, we can say price PE change is just 26%. But for the superhero multi-bagger stocks, it is 232% change. Price book has been changed for 230%, and price sales is 392%. People or the market are willing to pay a heavy, hefty premium for those multi-bagger stocks. So that is my time. Thank you very much for giving me this opportunity. We talked about the emerging market trends, emerging investment products, emerging market countries, and how wealth creation can be done through a diversified asset allocation and portfolio, and how equity analysis can also be done to spot the multi-bagger returns. So I thank you, and the moderator
Uh,
can take forward.
Okay, thank you, sir, for your very significant and helpful for the topic, whether it was a knowledge regarding GDP, per capita income, or income inequality, or high frequency indicators, or etc. Sir, thank you very much. Okay. Uh, Now we have joined our chairman, sir. Okay. We will introduce him first of all. The CA Purushottam Khandelwal, sir. He is a chairman of CPEC, vice chairman of the Committee for the Members in Entrepreneurship and Public Service, and convener of RBI, director of ICI. He is having a 25 years of post-qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he has devoted to fortifying CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus will be on upgrading of CPE program. Okay, sir. Uh, Sir, Purushottam, sir. Sir, please unmute.
Hello.
Yes,
Yes,
yes.
sir, you are muted.
Yes, sir.
Just you are audible? Audible?
Yes, yes, sir. Yes.
Yes, the respected vice chairperson of this CP committee, GC Misra ji, faculties of this second technical session, and my dear friend, regional council member from Ahmedabad, CA Chantan Patel ji, first faculty, Ajay Alay Shah, moderator Vijay Chauhan, secretary of CP committee, Ajit Nath ji, and all these fellow member who is watching this live. So the CP committee is a mother of all the committee, and we are dedicated to update the knowledge of our members throughout the year. So it's a few days left to complete the years of the CP committee, and we did a lot of work for the members at large. We organized throughout conference across the country, from Kashmir to Kanyakumari, from Bhubaneswar to Kutch. So, apart from the organizing CPA programs, we bring lot of changes in the CPE committee. This year, the calendar year will be the year to complete the CPE. Yesterday, we have statement. We have uploaded the statement on the CPE. So it's a legal requirement to complete CPE. So there is no option for members. My request, humble request to all the members, please compliance with the CPE requirements. It's a compulsory. It is under the guidelines issued by the ICI. So I will not take much of the time because the Chintan Pai is here, learned faculty is here. If GC Misra does not speak on, I request GC Misra to say a few words for the CP committee.
Thank you, sir.
Thank you, Chairman sir. Very respected
Yes.
Chairman Purushottam Bhai and two learned speakers who have joined virtually, Ajay Bhai and Chintan ji, and of course moderator Vijay Bhai, secretary of the committee Ajit Tiwari ji, and all the respected participants who have joined virtually this program. Good evening to one and all. Friends, under leadership of Purushottam Bhai, we have witnessed so many changes this year in the CPE committee. And one very important change that we are looking forward in this year, that is the consequential provision if the members do not complete the CPERs. So CPERs is not basically a formality as of now. We are following the developed countries, and now output-based learning is also on the card. We shall witness it in coming time, that whenever CPE is to be done, that is to be followed by the output-based learning model. Friends, two topics being covered today. One, wealth creation, which is, of course, a need for any individual who wants to live in the materialistic world. So money is needed, wealth is needed. Well explained by our first speaker, Ajay ji. And the second hot topic, which is to be discussed, one change which is being proposed under Section 43 B subclause H with respect to the MSME payments and their consequential provision to the Income Tax Act, and of course to the financial statements as well. So that is to be discussed by Chintan Bhai, and so many members have joined across the country. We welcome each and everyone. I'll not take much time. Keep connected to the CPE committee. One very important thing, what Purushottam Bhai has said, that we have to respect the provisions of the institute with respect to the compliance of the CPRs, and that CPR does not mean that that is just bookish figure to maintain 30 or 40 hours in a year. We have to learn, we have to deliberate, and we have to deliver for not only cause of the profession, but cause of the nation building. So thank you, Purushottam Bhai, for joining and guiding us. And thank you, Ajit Bhai, for your untiring efforts for doing this webinar on every Wednesday. And thanks to the moderator and, of course, very importantly, the two speakers. Thank you, one and all.
Thank you, sir. Thank you, sir, for your kind words.
Thank you, Chairman and Vice Chairman, sir.
Okay. Okay. Now I will introduce faculty for our second session, CA Chintan and Patel, sir. He is a qualified chartered accountant. He has over 20 years of experience working with SMEs, SMCs, MNCs as an auditor, advisor on Indian and international accounting standard, ESG reporting, etc. He has authored a book on Indian AS and ICDS published by Taxman. He has also delivered more than 500 sessions on various topics across multiple platforms. Over to you, sir.
Thank you so much, C. Vijay, for giving a brief introduction. And it's really pride pleasure to have along with us the chairman of CP committee, C. Purushottam Khandelwal, who is a dear friend and he has done wonderful tasks throughout the year. Purushottam bhai, hats off to you for all your efforts which you have done. And it's really good to see that every Wednesday you organize a session for members across India, irrespective of the region, but every member for which topics are relevant, you are organizing it. So wonderful task to you, sir.
Thank you.
And along with my co-speaker, C. Alay Shah, who has been deliberately going on how to create a wealth. I think it was one of the most important topic. Everybody wants to create wealth. So like very good deliberation on the topic, which is really a critical thing for all of us. And with this, Purushottam Bhai, I will take the session.
Yes, sir, please.
Okay.
Yes,
right. So, friends, the topic is a very relevant and very important topic. And let me share my presentation with all of you. See, this has been one of the very important topic because today, right now, we all have been struggling to identify how to comply with it. A lot of queries and issues have been raised by clients, corporates, enterprises about its implication. So, in my view, the role of chartered accountant is very critical because everybody looks down to us as a professional to provide advice. I am providing my views. So before I start my presentation, these are my personal views. These are not of ICAI or not of any other professional capacity. So my objective here is to have interpretation of the provisions and provide my views on these provisions. As I mentioned that the section has been modified, not current year. It was introduced last year by Finance Act 2023. However, effective from 1st April 23. But today we are discussing because its implication may be seen today in last 2 months of financial year. It will be most crucial. Why so? Which are the issue? So during this presentation, I'm going to cover on the very critical aspects. First is on what is the section 43BH requirement. Second, we'll look at the definition of what is micro or small enterprise. There is deliberation on payment due date because everything is revolving around the due date to payment. So how the due date of payment is defined. We'll also look at the practical case studies for expenses allowable. There is also provision of interest on delay payment. It's not a change. However, it has been there for so many years, but because of Section 43BH, this also has been critical for all of us to understand. What will be the reporting required in tax audit, company audit? At the end, I'm also going to cover on 10 burning issues, which includes applicable to traders and many more. So this is what I'm going to cover in this session. I will try to be a brief, and any questions if you're having, you please feel free to put a question at the end of the webinar because I have tried to cover many questions during my presentation itself. In case if you don't find answer to question, please feel free to write your questions in for webinar. Let us first foremost look at section 43BH. Clause H has been added, which says that any sum payable by assessee to a micro or small enterprise beyond the time limit specified in section 15 of MSMED Act. So I'm sure that everybody is right now aware about section 43B. So it talks about that certain expenditures are allowed on payment basis only. That is the main cornerstone of the whole section 43B. Clause H has been added, which says that any sum payable by assessee to a micro or small enterprise. So it makes it very clear that it is applicable primarily to micro or small enterprise and beyond credit period. So as far as the amount is paid within credit period, which credit period? As specified in section 15. So credit period is not what credit period both parties decided. Credit period as specified in section 15 of MSMED Act, then it shall be allowed, right, in that previous year in which sum is actually paid by him. So it makes that in case if the sum is payable to micro or small enterprise and if it is paid beyond credit period allowed in section 15, in that case it is allowed in the year in which sum is actually paid. Now that is the whole very critical paragraph which is added here. Let us look at the proviso. There's exceptions to proviso added here. It said that provided that nothing contained in this section except the proviso for clause H. So what proviso says? Section 43B proviso says that in case if you make payment before filing tax return, it will be allowed. That is what section 43B proviso says. However, exception to proviso says that it does not apply to clause H. That means that even though you make payment which is not allowed under section 43BH before filing tax return, then it will not be allowed. Means what? It will be allowed only in the year in which it is actually paid. So that is section 43BH. And let us now look at micro or small enterprise. For micro or small enterprise, Income Tax Act is not providing any definition. Also, Income Tax Act section 43BH does not make reference to micro small definition of MSMED Act. However, as it is mentioning and referring to section 15, we assume that all which is governed by section 15 will be governed by the MSMED Act. So for the purpose of understanding who is micro small, the micro small definition has been modified a couple of years back only, where it has made it clear that investment in plant and machinery and turnover, it has to be same for both manufacturing and service sector. Earlier, there has to be a separate condition for manufacturing, separate for service. Now they both have been combined together and says only one thing: look at investment in plant and machinery and also turnover. So for micro enterprises, if investment in plant and machinery is up to 1 crore and turnover is up to 5 crore, that is micro enterprises. For small enterprises, so for the purpose of section 43BH, we do just look at these requirements, that up to 10 crore rupees of investment in plant and machinery and turnover up to 50 crore rupees. Now again, am I referring to micro small? However, we also have to look at another point, that whether it is applicable to every micro small if they are qualifying this definition. That is again a question which we will again discuss further. So let us take case that if some enterprise is a micro or small, means having investment up to 10 crore, and so the most important thing, it is and both conditions are critical. Having investment in plant and machinery is up to 10 crore and turnover up to 50 crore. If the both conditions are fulfilled, then it is either micro or small based on its quantum of investment and turnover. So this is what a definition as per MSMED Act. I hope now it's clear as far as what is micro small is concerned. Let's look at next point, that is about the credit period. Now, first I'm trying to just provide you the understanding of the provisions. I know there are a lot of questions in your mind. Please hold your questions. I have tried to give response to all your questions in a later on in my doing my webinar. And thereafter, if you know if you have further questions, I am there to respond. So let us first look at that credit period. Because section 15 says what? MSMED Act and section 43B says what? Time limit specified section 15. So it is critical for all of us to understand what section 15 of MSMED talks about time limit. Right? So let us look at one particular example. Ram, a proprietor, has purchased goods from a supplier XYZ partnership firm which is MSME registered of rupees 2 lakh as on 20th March 24. The credit period agreed is 15 days from the date of invoice. Ram paid the supplier on 14th April 24. That is within 30 days of the date of invoice. Whether rupees 2 lakh is disallowed. See, the objective of putting this point is that let us have a clarity on understanding about the 45 days which has been going to market. What is the implication of 45 days? Here in this particular case, it says that the credit period agreed is 15 days and the amount is paid within 30 days, which is within 45 days, and credit period is 15 days. Then what? So it will be disallowed under section 43BH. Why? Because it says that the credit period should be as agreed by both supplier and buyer. However, in no case the credit period can exceed 45 days. That means what? That there has to be agreement. And if the agreement is beyond 45 days or 45 days, then only you are eligible to get 45 days. Otherwise, it is to be within 15 days. So please ensure that in case if there is no agreement, nothing is written, then it will be 15 days only. If it is agreed to be 15 days, it is only 15 days, it is not a 45 days. And then beyond that particular period, you need to look at the implications of allowance or disallowance. So that I'm trying to just solve the another issue with respect to the understanding of the current period and what is allowed, what is not allowed. Now, taking care of different scenarios, I've taken various scenarios to give you a basic idea, understanding about that what is allowed, what is not allowed. Ram, a proprietor, has received services or purchase of goods of rupees 2 lakhs from supplier XYZ partnership firm. It is a small MSME registered. At this junction, let us understand it is a MSME registered. If it is not registered, in what I'm going to discuss deliberate in later when I talk about budding issues. But this time, let us understand the MSME is registered. It is small MSME registered. The proprietor has received. It is a Ram is the buyer of the goods of 2 lakhs rupees in year financial year 2023-24. Now, question is that is the service allowed as expenditure to Ram in financial year 2024 in the following scenario? Note that for this purpose, the credit period of 45 days is agreed between both the parties. So, as I discussed, it is subject to agreement, and here is agreed 45 days. Income tax return for 23-24 is filed on 15 July 24. Let us look at the scenario now. I hope the question is clear to all of you. First is that purchase from MSME registered is a micro or small, right? Second thing is that that is for financial year 2023-24, and now credit period is 45 days. Date of supply is a 15 June, and date of actual payment is a 9 December. So credit period is 45 days. However, the amount is paid after 45 days. Is it allowed in 2024? Answer is yes. Why it is allowed? Because Section 43B Act says that in case if the payment is made beyond credit period, it will be allowed in the year of actual payment. So what is the year of actual payment? That is 9 December 23, that is 23-24. So even though it is not allowed on accrual basis, it is allowed on payment basis, but year is same. So there is no need to worry. So that is the reason why we all are cautious about February, March. Why? If for this particular period, if you have already made payment, even though credit period is beyond, you are concerned, you can still get allowance. However, if you have some goods purchased in last 2 months, having credit periods which is less, and then paid next year, then what? Let us look at that scenario also. Now, second situation. Date of supply 8th January 24. Actual payment is 23rd January. So within 15 days, payment amount is paid. So then there is no issue. It is just it is allowed on accrual basis. So I'm just trying to differentiate it. Accrual basis is in normal case, and payment basis is based on 43BH. Third case situation. Rate of supply is 17th January 24. Actual payment unpaid. As of the date on which the ITR was filed, that is on 15th July 2024, it was still unpaid. Now, what we done? In this case, as the number of days has already extended, it is beyond current period, and in that case, it won't be allowed as expenditure for 23-24. However, it will be allowed in the year in which the amount is paid. So if it is paid in 24-25, in that year, it is paid thereafter, then that in that year. So this is the way it has been done. Next, 10th March 24, supply is done. Actual payment is at 14th April 24. Payment interval, number of days are 35. Now, question come to picture is that the amount is paid in 24-25. However, the amount is paid is within the credit period. That is the reason why this is allowed in 2024. I'm again repeating here. This is within 45 days. So even though amount is paid in the next year, 24-25, but as it is within the credit period of 45 days, this is allowed in the year in which the transaction happens. That is in the year of 23-24, it is allowed. Fifth case situation. 22nd July 23 is the date of supply. Actual payment date is the 10th April 24. payment interval is a 263 days. Friends, in earlier scenario, it was paid, however, it is within the credit period. So payment interval is 263 days. So is the expense allowed? The answer is no. Why it is not? Because reason here is that if the amount is paid beyond credit period, what is credit period? 45 days. If the amount is paid beyond 45 days, it is allowed as expenditure in the year in which it is paid. What is the year in which it is paid? 24-25. So in the financial year 24-25, this will be this is paid, so it will be allowed in that year. 15th September 23 is the date of supply. 10th March 24, part payment is done of 1.25 lakhs rupees. On 17th May 24, 75,000 rupees is being paid. In first case, it was 177 days, and on second case, it was 245 days. So, as far as amount is paid in the same year, 2025, no issues. However, the amount which is paid in May 24, which is beyond credit period, and the next year, it is allowed on payment basis in the next year. Next scenario, on 3rd February 23, date of supply, date of actual payment is the 10th May 24. Right? So here, I think I'm sure that somebody may question about this point. Why? The supply was happening in the February 23. Now February 20 is what? In the financial year 2022-23, a year before the provisions become effective. So in that case, in my view, that this is not subject to disallowance. Why? Because it's already claimed in year 22-23, plus the provisions are effective from 1st April 23. So something which is happening before that, which is already claimed earlier year, this is not have impact. So old amount before 1st April 23, even though paid later on, there won't be an issue on disallowance point of view. Next point is that 21st March 24 is date of supply. Check issue date is 20th April 24. Check clearance date is a 10th May 24. So there is a payment interval of 30 and 50 days. As far as first case is concerned, it is paid within credit period of 45 days, it will be allowed. However, what happens that check is being cleared on 10th May 24. See friends, what happens that you may argue in the court of law that I have issued a check. How can I keep track on when the supplier deposits the check? However, if it is a court of law, you can definitely win the case. There are certain court laws or case laws available where it mentioned that once you issue a check and you are having documentary evidence to suggest that you issue a check, then it is not your headache. It is the supplier who has to make deposit the amount. So you have done your compliances. But in my view, if it is a standard practice is followed, because this is subject to manipulation. So in my view, it should not be taken as a normal business transaction where every time you issue a check and it gets credited after a long period of time. In exceptional cases, there is a chance to win if there's a dispute. But in my view, please don't fall into that kind of prey to have a normal practice every time that you issue earlier, check is issued in your record, or you get signature of somebody in your record. However, every time it gets deposited later on. So in my view, this can be taken as a case only when it is an exceptional case in court of law, others not in normal case. Now with this, let us look at another aspects of the interest on MSME delayed payment. Friends, this is not something new. But however, as we're talking about macro small enterprise payment, and we are concerned with the section 43BH, we also need to educate our clients about these provisions. Even though you are able to claim expenditure in your financial year on payment basis, however, you also have to look at the interest is a liability. And that interest is a liability, it is a certain, it is not optional. Even though supplier agree not to take interest, however, this is a legal liability which arises from MSME Act. So, as per MSME Act, in case of delayed payment beyond 45 days, beyond credit period, interest is liable at 3 times of bank interest rate. This is by law. All agreement, everything overrides that. So kindly ensure that interest is also being payable in case of delayed payment. Plus, addition to that, Section 23 mentioned that interest which has been payable or paid, it is not allowed as deduction by claiming expenditure in your income return. So please, we also be aware about these requirements. Let us look at now reporting part, and thereafter we'll move to the 10 burning issues as far as micro small enterprise is concerned. As you are aware that section in tax audit report clause 22 is already requiring to make some disclosure on MSME payment. Same way under Companies Act 2013, there's a need to provide disclosures of the amount which is payable, which is delayed payment, interest. So these are the disclosure requirements which are required made under clause related to the tax audit report and in case of companies. Now let us look at frequently asked questions, FAQs, right? So these are the 10 FAQs which I'm going to again discuss. Kindly, I'm repeating my disclaimer here that these are my personal views. It is not of ICI or anybody. And the objective is to interpret and provide you reasoning why I believe that. So along with my opinion, I also try to provide the reasoning why I believe that this is the view for the purpose of clarity for all of you. So let us look at there are 10 burning issues I covered. First is it applicable to only for registered micro small enterprise? If yes or no, how can I check Udyam registration details? Retention money, that may be a corporate practice to have a retention money. So money is retained 10%, 5%. In that is it to be disallowed as it is not paid? The very critical, very important, biggest issue for all of you, all of us, traders covered or not? Is it applicable to MSC and MSC or traders also? If the both parties agree in writing, that is the very standard question that I don't want interest. If the both parties agree in writing, then what? If the goods which is related, then how to compute days? What about provision of expenses? If there's a dispute in quality, then what? If I got registered as MSC later on, then what about prior supplies? Can payment be done on a LIFO basis? So these are the 10 issues which I feel that has been commonly asked, and I try to respond with respect to my views. Let us first look at the first point foremost. That is it applicable only in case of registered MSC only or not? Friends, so basically, if you just look at section 43BH, it mentions the word that a micro or small enterprise beyond credit period as a section 15 of MSME Act. So micro small enterprise is not defined anywhere. The only thing which is reference which is made is section 15. So let us look at section 15 of MSME Act. It says that where any supplier supplies any goods or render services to buyer, the buyer shall make payment thereof on or before date agreed upon. So word which is used is supplier. Now the micro and small is again heading here. But however, section 15 doesn't talk about micro small. Same happens in section 43BH. It uses the word micro small. It is not mentioned somewhere. So the word which is used in section 15 is supplier. Let us look at the supplier means what? Supplier is again defined at MSMD Act. Section 2, clause N, which defines supplier, means a micro or small enterprise which has filed a memorandum with the authority. So, friends, my humble view is that filing memorandum is nothing but a practical term, Udyam registration. So, the supplier which has been mentioned in section 15, that supplier is defined under 9N, and N use the word macro small. Even section 15 doesn't talk about macro small. And under clause N it says that which has filed. Even though section 8 says filing is optional, but for clause N supplier, it says if you filed and micro and small, then you're a supplier, and then section 15 comes into picture. So in my view, it's only able to register MSc. Means what? If you, even though your turnover is just 1 crore, investment is just 1 lakh rupees, you are micro small by definition. But if you are not registered, the supply is not registered, buyer is not required to look at allowance or disallowance as a section 43BH. So it all boils down to registered MSE as far as this particular clause is concerned. Now, I have received a lot of questions about, can you check Udyam registration details? Because somebody may got registered 3 years back, they supplied Udyam number to you while doing the vendor registration. However, then it may become medium over the period. How can you check, is it a medium or still micro small? So on MSMED website, government website, MSMED GOV website, there is an additional feature which has been added. And that features mention that on that portal you will find here that on print and verify on the portal of MSMED government website, there is a feature which is called verify Udyam registration number has been added here. So you can obtain from vendors who are registered under Udyam, you obtain Udyam number, and you can go and check on Udyam website by entering number. Once you click on that thing, you'll find this particular point where it said that Udyam register online verification. Enter Udyam number, enter code, verify. Here you'll find the details of the person, whether is registered and is it a micro or small. And this is openly available to everybody to verify based on Udyam number. So please have a system to get the Udyam number as a proof if they are registered or not. And then you can check on the website to see is there a micro, small or a medium. Now coming to the next question, that is about retention money. See, retention money, in certain cases what happens that some part of the money has been kept as retention for the purpose of performance of supplier. Supplier has provided services or goods. However, it is of such a nature that there's an industry practice going on wherein the some part 5%, 7%, 3%, 10% is being kept as per agreement between both the parties as a retention money, just to ensure that if the performance goes wrong, they can use it. So is it allowed or not? In my view, the 5% retention money, even though allowed, it won't be disallowed. That means it will be allowed. For example, 100 rupees is the goods or services purchased. 5 rupees is kept as a retention money. 95 rupees is paid. So question here is that whether 95 allowed or and 5 to be allowed only when it is paid, or 100 to be allowed. My view, 100 to be allowed. Why? Because there are two transactions netted off in one transaction. 100 rupees I have paid and 5 rupees I have received as a part of the contract, and that is a normal practice and trend. It is a reasonable, consistent way it has been followed by the parties since so many years. So in my view, the 5 rupees is for the performance and it has a different nature. So amount is already paid. So in my view, 100 rupees will be allowed the expenditure, not only 95. Now coming to the very important issue which I have been receiving regularly is about whether traders are covered. Why this question? Because the traders have been issued the MSMED registration. They do have Udyam number. Now, if they are having Udyam number, they are MSMED registered. I mentioned earlier that micro small enterprise was registered covered. Then why traders are covered? Why traders are covered or not covered? So let us first look at my view. I am of the view that traders are not covered for the purpose of section 43BH is concerned. Why is not covered? Because traders are registered only for the limited purpose of priority sector lending. They are registered only for priority sector lending. So let us look at the first MSMED Act, enterprise. So the enterprise has been defined under clause E of section 2, Why enterprise we're looking at? Because what is micro or small enterprise? So micro small we know by turnover investment. How enterprise can be So enterprise means an industry undertaking or business concern or an establishment by whatever name called engage in the manufacture or production of goods. So when they define the word enterprise, they make use of the word manufacture or production. There's no way they are talking about the basically traders kind. Also, they talk about services. So manufacture or production or services are covered as far as the definition is concerned. Now the question comes to picture, then why the traders are registered? Why they have been allowed to be get registered and get confused? So for that we need to look at this office memorandum. The office memorandum dated 1st September 21 issued by MSMED department. It says that the retail wholesale trader have been included as MSME. They have been included as MSMEs, allowing them to be registered on Udyam portal, and benefits to retail and wholesale are to be restricted to priority sector lending only. Further on, it says that thus the benefit to retail and wholesale traders are restricted up to priority sector lending only, and other benefits including provisions of delayed payment as per MSME Act are excluded. So, friends, this memorandum has made very much clear that the purpose of including and providing restricted to traders are only for limited purpose of priority sector lending. That's why they would be eligible for the benefits which are allowable here. So, in my view, Section 43B(h), if the amount is being purchased from buyer who is a trader, even though it's registered under MSMD Act, no need to worry about that disallowance part, and yes, it won't be disallowed. I hope that was clear. Now let us look at next point. That question come to picture that yes, sir, I am micro small enterprise. I am registered. I am a trader. We are there to get benefit. Am I required to also make payment within 45 days? Answer is yes. You are going to receive benefit, and you are also going to give a benefit to others if you are there micro small enterprises. So object is that it is applicable to every assessee. There is no classifications of regarding the audit or turnover or other things. It is applicable to every assessee, irrespective of the audit, unaudited, medium, large, micro, small traders. So applicability of allowance, disallowance is to all. Disallowed only when your payment is to the micro, small enterprise which is registered. Now, very common issue which everybody says that if the party, if both the parties agree in writing to pay in 60 days, then what? 45 days is what I am saying is the highest credit period. If the both parties agree for 60 days, then what? Friends, the objective of MSMD Act is to protect micro small. Micro small doesn't have any voice. They can't even say if it's 60 days, they will sign 60 days. They will say 6 months, they'll sign 6 months. So there's no voice to micro small. There is a reason why this act overrides everything. So Section 15 of MSMD Act says that your agreement is not going to be seen here as far as the beyond 45 days is concerned. But it is less than 45 days, yes, your agreement will be the riding force. Next point, that is if goods reaches after 20 or 30 days, for example, then how to come with 45 days? Because we say I have to make amount, I have to pay within 45 days. Purchase is, for example, 1st January 2024. I received on 30th January 2024. Then whether I will get only 15 days or 45 days will start from the date I received it. So for that, it's very clear that we don't look at appointed date. Appointed date, which is defined under Section 2, Clause B, it says that the following immediately after the expiry date, and the date of acceptance means date of actually delivering goods or rendering your services. So here it has been very, very clear that the date on which you actually receive the goods. So please keep documentation, e-way bill, your internal documents, GRN, keep all documentation which are possible, which justifies the date of receipt of goods, and from that onwards you will complete 45 days. What will happen in case of provision of expenses like audit or others made on 30th March 24? That means invoice received on 30th November 24. See, the provision was made on 30th March 24. Invoice received in November 24 and payment done in April 25. So in my view, the provision is already made, and the disallowance happens only when it has been paid beyond credit period. So when you file tax return and this provision is something which is not being seen here for section 43B. So provision is to be allowed in financial year 2023-24, and even though subsequently the amount is paid beyond credit period, there won't be disallowance because amount is already allowed as expenditure based on provision. Now, coming to point is dispute. I received goods on 30th January. 1st January is the date of invoice. I received goods on 30th January. I mentioned that you have to complete 45 days from the 30th January. However, when I just check on 1st of February, I noticed that the certain goods are not as what I want. Quality is not correct. So I disputed. So in that case, it says that if the dispute arises within 15 days from the date of delivery of goods in writing, then till the time the dispute is resolved, the 45 days will not be started for payment. So for example, if the dispute gets resolved on 2nd May 2024, so from 2nd May 2024 till the 45 days is allowed for the purpose of making payment. If you get registered as MSE, the supplier has supplied goods on 1st January 24. Thereafter, he comes to know on 24th January 24 that yes, he will get benefit of early payment if he gets registered. So he gets registered on 1st February 24. What about supply which is made on 1st January 24? Is it whether it is eligible to get benefit? The answer is no. The benefit is available only after the micro or small enterprise get registered. So thereafter only earlier benefit will not be available. Last question, can a payment be applied LIFO basis? Means for example, I have a certain goods or payment where I have received a supply of earlier year, I have not been payment, later on I am in payment. Can I adjust payment later on instead of earlier? How it happens? For example, on 1st February 2023, goods received of 100 rupees. On 1st July 23, another goods of 50 rupees is received. Amount is not paid. So 100 rupees is not paid of 22-23 and 50 rupees of 23-24 is not paid. On 1st February 24, 50 rupees is paid. Now, if the 50 rupees is being counted as of 20 as LIFO basis, means of 23-24, there won't be disallowance because 100 rupees is of earlier year. However, 50 rupees is adjusted against the first invoice, that's February 23. Then 50 rupees of 23-24 will be disallowed. So, in my view, it should be on first in, first out. There is no clarification on that part, but that is the general normal tendency. Unless if you are having some documentary evidences or practice is followed across industry, even before 43B ash, then probably it may be allowed. But in my view, it should be on invoice to invoice, first in, first out basis. So friends, these are the few things which I feel are critical. And before I end, let us have a takeaway. And then I will talk about the very important resources which can be useful to you as far as this particular process is concerned. So I also develop a practical resources which can be helpful to any CA form, which you can modify for your purpose. So first is that please ensure that provision is applicable to all associates. It is applicable to everyone, whether you are micro, small, medium, large, audited, unaudited. However, it is applicable to you when in case of payment to be made to registered micro, small, trader is not covered. If the expenditure is incurred and paid within financial year, 23-24 expenditure incurred and paid, even though it's beyond credit period, nothing to worry, it is allowed. If expenditure incurred during financial year and paid next year, but however payment is done within credit period, it is allowed, nothing to worry about. Only when the expenditure incurred during financial year, paid next year, which is beyond credit period, it will be disallowed. So that is the crux of the whole requirement which we discussed. And as I understand, interest, as I explained earlier, interest on delayed payment is also to be considered, and that is to be disallowed from this purpose. So this is the overall understanding. I hope that I have tried to cover a lot of issues which I have come across during this journey. I also uploaded a short video on basically 43B H compliances, then video of FAQ stand burning issues, plus a word format of declaration format for obtaining status of a supplier. You may forward this word document by changing as you required to your clients, and you can advise clients to obtain a declaration from supplier. Are they micro or small? They are registered or not? And then then it can be verified on website. So that draft format word file I have also uploaded, plus communication to client. A draft letter has been prepared. How can you communicate to client about these provisions? So that these are available on the website sageindia.com. There is MSc pages created only for this purpose, and I'm sure that it will be helpful to all of you. So now with this, I keep this floor open for all of us to discuss and understand, and I hand over charge to ICI. They can look at if any questions have been received which are not addressed here, then I can really take care and respond to that.
Thank you, sir. Actually, there were more than 100 questions, but actually you covered most of. Uh, we have currently, first of all, I would like to inform we have currently more than 1900 participants. Okay, sir. Sir, there is a few questions summarized. I would like to ask first question. Sir, will this section impact section 44 AD oblique ADA? Will it be applicable to assessee opting for 44 AD or ADA?
Yes, I think it's a very relevant question. I have not purposefully answered this question. I'm aware about this is a very burning issue, but let me brief about my see. When you just look at 43B and 44 AD ADA, in both sections, it start with notwithstanding anything contained in the earlier provisions. So these both sections start with notwithstanding any earlier provisions. So they both are saying that they are supervising everybody else. But however, in my view, it should be applicable to even in case of 44 ADA. Otherwise, the objective of this section may not have been served. So, in my view, 43B H disallowance will be applicable even to 44 ADA. But I'm very much sure that for this particular point, I think that there has to be some kind of clarification which is expected to be arrived from English department.
Thank you, sir. The second question is what impact on manufacturer if manufacturer purchase goods from traders and vice versa?
Yes, I think I covered earlier this question, but see, manufacturer, any accessory, as I mentioned in last slide also repeatedly, it is applicable to all accessory. Means even if you are manufacturer or your trader or your micro, small, medium, large, very large, audited, unaudited, listed, unlisted, for disallowance of 43BH, it is applicable to every. So as far as disallowance is concerned, is applicable to everybody. When it is allowed? When you purchase from micro or small that are registered. I hope that is now clear.
Yes, sir. Yes, sir. Thank you very much. Sir, third question, and very important. Whether auditor expected to confirm MSME status of creditor while conducting tax audit?
In my view, we should definitely go ahead with respect to our standard of auditing compliance, and we should look at least materiality basis. It is our responsibility to look at. We cannot blindly ignore. We cannot take a blindly MRL from management saying that management is given, it is compliant with it. We should ask for documentation at least for material cases. Where in such case where MSMED government department has already published Udyam registration, verify Udyam registration number has been provided in portal. So we can also check and get declaration. However, let us also look at limitation. Limitation is such where, for example, you ask your client that provide me one MFA registered. Client say we don't have anybody registered. Probably a client may not provide information to you. Then what happens? So in that case, I think the responsibility cast a little bit upon management and also us also. So if you're reason to believe it is MSO registered, for example, in invoice itself is mentioned, it is Udyam number. You can't ignore that Udyam number is there still because as a part of audit, you already verify documentation. The documentation is available. When in invoice itself is mentioned, Udyam number is this. And if we say it is not macro registered, so my view is that we cannot be blindly reliant on any MRL. MRL should be taken one. Management representation should be taken one. Second thing, wherever documentary evidence is available, which is reasonably expected for us to verify it, we should verify, check, opt in, and give documentation.
Okay, sir. Thank you, sir. The next question is, whether some payable include taxes also like GST?
Yeah, very good question. I think I will try to include this question also in my next PPT because this has been received another time. Let's take an example that 100 rupees is the amount of expenditure. And when I receive invoice, it has 100 plus 18 GST is there. So 118 is the invoice amount which I receive. When I book in my books of accounts, the expenditure in my books is 100 rupees. 80 rupees, if the ITC is allowed, it will be part of my balance sheet. The provision, section 43B is on disallowance. So disallowance will come to picture only when you claim expenditure. You claim expenditure of only 100. So there is no point of disallowance of 18. Then 100 will be disallowed.
Okay, sir. Thank you. And there's the last one, whether this section is applicable for trader also. I think you have clarified very clearly.
Yes, I clearly.
Yes, sir. Okay, sir. Sir, thank you. Actually, it was the very hot topic in current scenario, and you have cleared all the doubts. And sir, I think all participants will be benefited from this. Okay, sir. Thank you. Thank you very much, sir.
Thank you so much, Vijay. It was really wonderful to have you here and
Yes,
managing, monitoring so many participants and a lot of questions. Because I know that
yes.
when you receive 100 questions and then sorting 100 questions and arriving at the 3 or 4 is a critical thing. So thank you so much, Vijay. Thank you so much, Alai. It's been there. You have been there throughout the sessions. It's really very important to have you, to see you here again. And my thankful to again the CP committee ICI for giving me opportunity, calling me here, sharing my views, and thanks to all of you.
Thank you, sir. Thank you, Alai, sir. Thank you very much.
Thank you. Thank you so much. Thank you, CA Chintan ji. It was an amazing session and always an honor to listen to you. Very nice.
My pleasure. My pleasure.
Yeah.
Thank you all the participants, sir. Thank you very much. I am concluding this.